This is Al Brooks, and today is Friday, April 26th, 2013, and I am recording a blog today to correspond to an article that is coming out in the May issue of Futures Magazine, and that article discusses scaling into trends. In that article, I used the E-mini as an example, and today I'm going to be using the Euro currency futures, which is identical to the Euro dollar Forex cross. I trade mostly the E-mini contract, a 5-minute chart, and I day trade. But throughout the day, especially when the E-mini is fairly quiet, I look at other markets, and I often place trades in the Forex markets or the currency futures like the Euro or the Yen. I also place trades in COMEX gold, crude oil, natural gas, and stocks as well. I don't watch the charts very much during the day. I watch the 5-minute chart all day long. So when I do take a look at a chart, for example, in this particular video, I'll be talking about the Euro futures contract, which is identical to the Forex, the Euro versus the dollar cross. And if I see that a trend is underway, and it looks strong enough so that I believe I can make a profitable trade, I go ahead and place my trade, right? So if I feel like the market is moving, then and I did not take the original entries, and I still want to enter, I decide that how to enter. There are many ways to do it. I'll talk about some of them, and I use the original swing stop that I would have used had I entered the trend at the earliest point. If I feel that I might be buying late in the move and that the market might have a pullback, I'll consider scaling in lower. So in other words, take a smaller initial position and then scale in lower. This is the 5-minute Euro futures contract, and I could just as well have the Euro dollar cross up here. The Forex market does not matter. The charts are virtually identical. And what we have is a bear breakout and then a channel with a lot of two-sided trading. Lots of reversals, small bars, not really much in terms of consecutive big bear bars. We have a couple here, but they have prominent tails, and the bars are not all that big. Tight trading range here, bull bars here, lots of tails on the bottom of the bars. When I see this channel, I'm not thinking strong bear trend. What I'm thinking is a bear leg in what will become a trading range. This is a strong bear trend. This is a channel, and it has a lot of buying pressure within it. Lots of reversals up, lots of prominent tails below, and lots of bull bars. So I believe that this bear trend will end up being part of a trading range. So I'm expecting the market to turn up and maybe down and up and down and up. It's basically a spike and channel. Although it's not really a wedge shape, I could draw it using bodies or some other technique to make it look more like a wedge. To me, I think it'll behave like a wedge or some kind of a climax bottom or some kind of end of the bear trend, and I'm expecting at least 10 bars and 2 legs sideways to up. So as this is forming, I'm looking to buy. If I'm watching this chart tick by tick, we have a 2-bar reversal here, a small 3-push pattern here. It's also an expanding triangle, down, up, more down, more up, more down, and a 2-bar reversal. It's also a larger 3-push pattern, 1, 2, 3. Spike and channel patterns usually end with some kind of a 3-push pattern. So to me, I would be looking for a reason to buy. There are other things going on here as well, measured moves, but you don't need them to be thinking that there's way too much buying pressure in this channel for this to continue much further. And the 3 pushes down here and the 2-bar reversal here, to me that's reason enough to buy 1 tick above this bull bar. We have a bull breakout here, but a tail, pretty prominent tail, so not good for the bulls, all right? But it's still a bull breakout. This close is above the high of that bar, so some buying pressure. And the follow-through bar also has a bull body, so that increases the chances that the market will go higher. So had I been watching this tick by tick, I could have bought above the high of this bull bar. And then we have this breakout bar, not all that strong, but then we have a bull inside bar for the pullback. This would be another entry. Here's a breakout. You could buy this close. We have follow through, another bull bar after the breakout. You could buy this close, all right? If I decided that, well, it's not all that strong, we'll probably end up in a trading range. Let me buy lower. Nothing in here, I think, is a very good setup for a buy. Tight trading range here, small bull bar compared to these two bear bars, not good. A pair of doji bars and a tight trading range, not reliable. A bear signal bar here, not reliable. So to me, none of this offers a good opportunity to go long. However, here we have a large two-legged correction. The market corrected down to here, bounced, and corrected down to here. A good-looking two-bar reversal, a breakout test of the original entry, and a higher low major trend reversal. So we have a bear trend, a trend line break, a very strong trend line break, and a two-legged pullback to a higher low. So this has lots of things going for it for a reasonable entry above the high of this inside bar. At this point, if you entered here, stop would be one tick below its low. And I would be looking for two legs sideways to up from this point as well, because it's now a higher low major trend reversal, and usually the market is ends up giving two legs sideways to up. We had our first leg here, a two-legged pullback, a second leg here. We might have had one more here. I don't remember. I think it was mostly sideways for the rest of the day. But in any event, this would have been a reasonable low risk buy. Just like buying above here or above here is low risk. The number of ticks that you're risking from your entry price to here, your stop price, or from your entry price here to your stop price here, is small. If you bought later, up in here or up in here, your risk is bigger, the stop is further away, but the probability is higher. We're starting to get a series of bull bodies, and that increases the chances that any pullback will be followed by a test of the high of the move. I watch the E-mini all day long. Sometimes when it gets quiet and is not offering much in terms of trading opportunities, I'll look at other markets. The ones I usually look at and the ones where I usually place trades are the euro, the yen, the Forex or the futures, COMEX gold, crude oil, and natural gas. And I also place trades in stocks. 99% of the minutes during the day, I'm looking at the E-mini. But 1% of the time, I'm glancing at these other markets and looking for always in reversals or early moves within trends. In other words, strong breakouts. And here's an example of a strong breakout. And once I see a strong breakout and I think it's likely to have more up, right here, I think any pullback will be bought and that the market will test the high of the move, which it did, right? I'm looking to buy. And there are lots of ways to buy and lots of reasons to buy. In general, if I feel like I'm buying fairly high up and late and a pullback might come at any time, I usually buy small. So had I bought anywhere up in here, right, fairly late in the trend, if the market continued up for 20 ticks, I probably would have taken my profits, or I probably would have exited most. On the other hand, if it pulled back, started pulling back, I would have added on. Now, the key to adding on in a trend is deciding what your total risk is. So let's say in the euro currency futures, you're willing to risk a total of 100 ticks. Each tick is $12.50, so you'd be willing to risk, let's say, $1,250 on the trade. If you were trading the Forex, you could trade a much smaller position, and your risk could be much smaller as well. But for argument's sake, let's say you're trading the Euro futures contract, this chart, and you're willing to risk 100 ticks. Had you bought the absolute worst price way up here at the top of this bar, right? Your stop is one tick below here, you'd be risking 49 ticks. So that means any additional position that you take for any reason, the risk on that position plus this 49 tick risk has to be less than a total of 100 ticks, because that's the most you're willing to risk on any trade. Typically, when I'm thinking about buying the market, had I not bought up here, I would have looked to buy a pullback. And one thing I usually like to do is find areas where the bears are trying to take control. Since I believe the market will have a second leg up, anytime the bears look strong, I believe that there will not be follow-through and that the market will reverse. So I like to buy the closes of strong bear bars. I also like to buy breakouts below other bars, right? So I could have bought one tick below this low, expecting the reversal down not to go far. I could have bought one tick below this low, or on a limit order at that low. Same over here. I could have placed a limit order at this low and got filled here. Same here. I could have placed a limit order at this low, been filled here, or filled here, right? Another thing I like to do is decide what I think a reasonable scalp is in the market under current conditions. Remember, I said recently the market has been providing a lot of 20-tick scalps. So if I enter on a stop and I am trying to exit with 20 ticks, the market has to move 22 ticks. So if I sold one tick below the low of this bar and tried to get out 20 ticks lower, it usually would have to go one tick below my profit target for me to be filled. So one tick stop here, 20 ticks down, and then one tick more to get filled. So it has to fall 22 ticks. A lot of times what I will do is I'll look at that and I'll say, the bears need it to fall 22 ticks. I think the market is always in long. The bears probably will not get their scalp, and therefore I will try to buy just above their profit target. So if I'm not going to follow this chart closely, I'll often place a limit order 20 ticks or 18 ticks below the bear signal bar, which I did. Right? So the fill was over here, and the stop was over here, and I don't have to watch the market very much. I believe the market is always in long. I think we're in a bull leg, probably within a developing trading range, but that we should get a second leg up. So if I buy here 20 ticks down, my stop would be, it turns out, about 20 ticks lower. I think I'm probably going to make money. So mathematically, I can place a limit order to take profits 20 ticks above my entry price. My stop would be 20 ticks below. So my reward is equal to my risk, but I believe probably the market is always in long and it will have a second leg up. So mathematically, I can exit with a reward equal to my risk. I don't have to have a reward 2 times my risk. I can get out with a reward simply equal to my risk because I think the probability is high. Probability is at least 60%. So I could have bought anywhere up in here, right, and risked as much as 48 ticks. You know, if I bought in here, let's say I bought here, let's say I bought half a position here, right, I'd be risking about 25, 30 ticks. I could have bought more 10 ticks lower, been filled over here or over here, right? Doesn't matter. I could have bought 2 contracts here. So if I bought, let's say, 1 Euro futures contract here and I bought 2 more here, right? If the market hit my stop, my total loss would still be under my maximum allowable loss of 100 ticks. That would be acceptable. How else could I have bought these bear bars? I could buy bear closes, strong bear closes, betting that the attempt to reverse the market will fail, right? So you could buy that close. Here's another breakout by the bears, close below this tight trading range. You could buy that close. Here's a 2-bar reversal. The market went up here and down here strongly. Do I think the bears will take control over the market, or do I still think the market will have a better second leg up and that it'll test up the high of the first leg? I think it's probably going to test up. I could buy that close. Here's another bear breakout, right? I could buy that close. Again, any close that I buy, or any buying for any reason, my initial stop will be 1 tick below this low. And however many contracts I trade, the total, if my stop gets hit, the total loss from all of the contracts has to remain below whatever maximum I set. I'm talking about 100 ticks. I could easily have said, well, my maximum loss would be 50 ticks or 30 ticks. It doesn't matter. If my initial stop goes below this low, right? Let's say the most I'm willing to risk is 30 ticks. Then the highest price I can pay is 30 ticks above my stop, right? So if I was willing to risk up to 30 ticks, I could buy, up anywhere in here, and if I'm stopped out, I'll be okay. If I got a really good entry price, and I was willing to risk 30 ticks. Let's say I bought here and I bought there. So if I bought here and then bought more on this close, my risk would be less than 30 ticks. And had I tried to hold for 20 ticks profit, I would have had a 20 ticks profit here or here, right? A lot of times when I scale in, if I feel like I scaled in too high, let's say I bought 1 tick above the high of this bar, right? And I bought more 20 ticks lower, I would have been filled right here on this low. And that tells you that a lot of traders did just that. The high of this bar is 33, right? 130.33. So if I bought it on a stop 1 tick above, I would have been filled at 34. I would have tried to add on 26 lower, and I would have been filled over here. When I do that, I usually try to get out about break even. So if I bought here and added on 20 ticks lower, I'll try to get out of the entire position around my original entry price. And you can see the market came back to that price. And why did it sell off? Because a lot of traders bought either above the high of this bar, or they bought this close, and they were disappointed by the sell-off. They added on here, and when the market came back to their original entry price, either this close or that high, they exited the entire position. They get out around break even on their first entry, right? They may have taken a 1 or 2 tick loss, maybe 1 or 2 tick profit. And then on their second entry, they would have made about 20 ticks. That's a very common situation in trading. If you take the earliest entry and the market pulls back, traders will often add on lower and then get out of the entire position when the market comes back to around the original entry. So they get out break even on the original entry and with about a 20 tick profit on their second entry down here, for example. All right, that's all I have to say about this particular chart, and I hope you found it helpful. Takeaway message, if you do see a trend begin, or if you look at any chart and you see that it's bullish and it will likely have more up if there's going to be a pullback, you can enter at any time and you can add on lower as long as your total risk remains less than the total risk that you're willing to assume with any trade. And this is a very good thing to do with markets that you don't watch tick by tick. As I said, if you're watching tick by tick, you would have had a smaller risk by entering over here or by entering over here. But if you're not watching tick by tick, you can trade smaller, use a wide swing stop. It does not matter where you enter. You can enter anywhere in here. Your stop is still down here. You can enter anywhere in here. Stop is still down here. If you buy too high, you can add on lower as long as the total risk from your original entry and your second entry remains less than your total allowable risk. And I was using, in this example, 100 ticks. Thank you. Appreciate your attention. Again, this is Al Brooks, and this is the end of my blog for Friday, April 26, 2013. Thank you.